Hello and welcome to Weatherstone Capital Management's Market Outlook as of July 2021. I am Michael Ball, Managing Director of Weatherstone Capital Management. This quarter, we're going to take a brief look once again at COVID cases and some of the important measures that we're tracking. We're going to take a look at the U.S. and global economy, see how they are rebounding from the COVID recession. And then come back and revisit equity market valuations, where they stand in a longer term historical context. And we'll look at how valuations can impact longer term investor returns and some of the secular cycles that we see there. We're going to also then talk about strategic and tactical investment strategies, how they can differ from one another, how can they be beneficial in different parts of the economic cycle. And then we'll briefly cover some of the current positioning, some of the areas that we're focusing on as far as equities and fixed income portions of our portfolio. What I anticipate to be our last COVID update, we continue to see cases and fatalities moderate. And most importantly, the thing I wanted to show is, we've now moved into the zone where the targets were for herd immunity when you start looking at both the people who have had COVID and now have antibodies and the people who have had vaccinations. So we're starting to get to a point that the economy should be able to reopen and function at a pretty much normal level, even as we go into the next upcoming cold and flu season. There are some other hotspots around the world that have lagged a bit behind and are seeing some bigger, more troubling spikes. But at least as far as the U.S. goes, we seem to be getting to the tail end of the pandemic. Also, as we look at vaccination levels around the world, the U.S. continues to be quite strong. Some of the other countries around the world are catching up, and overall, in many of the main developed countries, we're seeing strong immunization levels globally. So this should also, on a global level, help to bring an end to the pandemic. As we look at how that is impacting the reopening of the economy, one of the most interesting statistics is the number of job openings. Obviously, we hear a lot on the news about many businesses having some challenges finding employees and getting back to being fully staffed. We've actually moved to a record number of job openings out there in the economy. So there is a significant need that businesses are trying to fill as they move to play catch up for some of the backlog in demand that has built up over the past year. So this should be good news both for the economy and those in the job market being able to find jobs to get back in, and also on a wage front to have a bit more competition for labor than what we have seen in the past. As we look at how the global economy is rebounding from COVID, this snapshot that takes a look at purchasing managers indexes that measure both manufacturing and services can paint a pretty good picture for us. Green indicates growth, red indicates retrenchment, and yellow and orange indicate various levels of slowing. And so we can see on the right-hand side, obviously, where COVID kicked in and economies generally slow down quite quickly. They're now, in most cases, moving back to a pretty good level of green, indicating some pretty strong, pretty consistent growth. And that tends to be quite consistent virtually across all of the segments and regions of the world. So it's showing that not only is the U.S. recovery and reopening, but it's quite broad-based as well. One of the biggest factors driving the economic rebound has been just the extensive amount of government stimulus that they have poured into the economy. And to get an idea of the magnitude of that, this chart, and particularly the portion on the top right-hand side, shows the size of the budget deficit relative to the economy in 2020 and 2021. Both are running right near 15%, which is larger than anything that we saw even during the global financial crisis. So obviously running budget deficits this high is not ideal, but it has helped to prime the pump, so to speak, to get the economy picked back up and moving forward once again. With the economy beginning to return to normal, let's take a look at valuations in the stock market because they are important on a long-term basis. We'll take two different pictures of this. The first one, as we look at the chart we have here, particularly the bottom clip, this takes a look at what the average price to earnings ratio is for basically the median stock in the S&P 500. It goes back, clear back into the early 1960s, and we've reached levels that are extremely high, frankly only seen back in the late 1990s. The numbers currently are probably a little bit elevated because of the declines that we saw in earnings from last year, but with the stock market rebound to record highs, it's basically showing that high levels of optimism are priced in terms of what companies are going to provide in terms of earnings in the future. Some people do not like to use price to earnings because they feel that earnings get adjusted quite a bit in terms of accounting for taxes and some of those factors. So if we look at a more broad-based measure, looking at a price based upon sales and how that valuation looks, this chart gives you what that would look like. And so we're essentially at record highs, but that's trended up over time. So if we look at the very bottom clip, we have the price to sales adjusting it for how much it is above or below the long-term uptrend line. And we're pretty much back up once again also to some of the highest levels that we've seen. So regardless of whether you're valuing stocks by earnings or by sales, stocks are back to being at very lofty levels. One of the reasons for this is that when investors are looking at getting a return on their money and they're comparing the bond market as an alternative to stocks, it's just not nearly as attractive as what it has been in prior decades. The chart that we have here basically shows how much income would be earned on an average $100,000 savings account going back into the 1990s. And you can look at how that ever since we hit the global financial crisis over a decade ago, interest rates have been low enough that you haven't had a single year where that has even kept up with inflation on average. And so investors realizing that have directed or kept a higher portion of their allocation in stocks than what they probably otherwise would, in the hopes of generating higher income off of dividends or potentially higher growth to offset the low interest rates that they're receiving in bonds. So this is one of the primary drivers for higher valuation. Oftentimes investors hear the term stock market cycles, and we want to talk for a minute about secular stock market cycles, the very long-term cycles that can happen out there. And this chart can give you a pretty good feel for how these can play out. This chart goes clear back to 1900. It looks at the stock market on an after inflation basis, and you can see that the long-term trend is up, yet you can get some very long periods over which you're really not going to grow your wealth, in some cases for a decade or more. And during some of those declines, typically you've seen the value of your investments drop by nearly 50% or more in some cases. And so for investors, if you have a very long time horizon, these will tend to even themselves out. When you start to become a somewhat more shorter term, then it becomes pretty important to look at potentially where you're at in some of these cycles. Because if you're a normal retiree with a long time horizon of going, 20, 30, 35 years potentially in retirement, typically you can about be guaranteed you're going to hit both types of environments at some point going through your retirement years. When we look at how these longer term cycles impact returns over varying time periods, we find that average annual returns, even when we look over longer time periods, such as 10 years, can vary very significantly from the long-term averages. Some investors, particularly when they're entering retirement and need to begin living off of their investment returns, find these extended market swings very difficult to live with, as the variability in returns causes large swings in both the value of the assets and in how fast they may be spending down their assets if they need to sell investment assets that have declined significantly in their value as they're needing to fund living expenses. One of the ways to mitigate this is to diversify the investment strategies a person is using in the stock market to come up with a less volatile experience. Let's take a look at this through a comparison of rowing versus sailing. One way of comparing some of the different strategies that can get us through some of the different market cycles we may encounter during our investment careers is to look at two different approaches to getting across the lake in terms of either rowing versus sailing. So if we're going to go across the lake using a sailboat, we're going to look to the wind to be able to push us across as we use the sails on the boat. If we have favorable winds, our progress can be quite rapid at times. If the wind's a little bit slower, obviously the speed may be a little bit less. If the wind is not there, or even if it blows against us, then that may push us backwards. We may not really make any headway at all. This is somewhat similar to using an investment portfolio that's going to be highly correlated to the overall stock market. When its stock market is very strong, you're going to catch the bulk of all those gains. And likewise, when those periodic declines happen and there's those secular bear markets, you could see similar declines as what the overall market is likely to experience. You're basically looking to the overall movement of the market to provide your long-term returns in that type of an investment strategy. Let's compare this with deciding to get across the lake by using a canoe or another boat where you're rowing. If you're choosing to go this route, it's going to be less dependent upon the wind and more dependent upon the amount of rowing and the speed at which people are rowing in the boat to determine how fast the trip across the lake may be. Similar to rowing, if a person utilizes absolute return investing strategies, they're tending to look for opportunities that can move the portfolio forward, kind of regardless of what the wind is doing. If there is wind out there that's pushing things, it can be of some help, but it's not really the sole determinant of what drives the portfolio. And so people who tend to take these type of strategies tend to be looking for more consistency. They're also typically more comfortable giving up some of the extra speed that can be achieved at times, let's say if they were in a sailboat that could go faster, in return for the greater predictability and flexibility from some rowing. As a quick example, let's look at how these two types of strategies can generally differ from each other and some of the advantages and disadvantages of each. And we'll take the example of a reasonably strong year for the stock market, followed by a weak year for stocks, then a subsequent very strong year. The non-correlated portfolio does not keep up with the market-driven portfolio in years in which the stock market does well. This can happen for a variety of reasons. It may be due to only having a moderate amount of money allocated to things driven by the market, with the majority being allocated to other asset classes. Or it could be that market-driven exposure is only used when there's a very high probability of making money. So there was a much lower percentage of time that it was actually in the market. With a market-driven portfolio, it's assumed that all market risk is worth taking. In the year in which the market-driven portfolio sustained a large loss, the non-correlated portfolio may have suffered a significantly smaller loss due to similar factors. Going over the 3-year period in this hypothetical example, the non-correlated portfolio had a lower average return and lagged whenever the market was up, but ended up with a larger total gain due to the flexibility that allowed it to minimize losses significantly. That is the reason why we like and will use tactical strategies frequently in investor portfolios. The example we're looking at can vary significantly based upon the types of market environments that are experienced, and over a longer time period, it shouldn't be expected that a non-correlated strategy will outperform one that's market-based. They usually will not. But the main point is that in an environment such as the one we have now, when stock valuations are high, and most bond yields won't keep up with inflation, that being more flexible with your investment approach and diversifying the investment strategies that are being utilized may help in building a more all-weather portfolio. In conclusion, just as most modern sailboats use a motor or some other means to get them to their destination when the wind alone won't do the job, it's useful for investors and for those of us who are financial advisors to look and assess the different investment strategies and options that are available to us and incorporate those to best help you to achieve your financial goals. Turning now to how we're currently positioning in the tactical equity portfolios that we manage. Our short-term risk measurement model has remained positive through the first half of the year and has remained fully invested. It's recently been moving down to the low end of neutral, and as a result, we have reduced some of the volatility in the portfolio by moving away from some of the small cap stocks and some of the more volatile sectors that we had into areas that tend to be a little bit less volatile. Our international risk measurement model had likewise been positive, but here in early July, it turned to being modestly negative. And as a result, where its expectations are that the returns are expected to lag that of the U.S., we have temporarily eliminated most all of our international equity positions and brought them back into U.S. positions, or in some cases even added it to bonds. When we're looking at some of the sectors of the markets that are ranked well and which we tend to own a little bit more of, areas such as consumer discretionary and telecommunications are some that are ranking quite well. Also, certain areas within technology, some of the semiconductors have also been a bit more positive for us here recently. Turning now to our positioning in the fixed income markets, we've continued to favor the economically sensitive bond categories over government bonds and the highest quality bonds out there. That served us well. As we noted last quarter, the first quarter of 2021, high quality bonds, government bonds, struggled, having one of their worst quarters in nearly 30 years. The second quarter was modestly positive for those bonds, and overall, virtually all areas of the bond market did okay. We continue to find that bonds backed by housing continue to perform very well, and we're quite comfortable with those positions as long as we're continuing to see strength in the housing market. When we look at corporate bonds, we tend to prefer bank loan funds over high yield corporate bonds, both because the bank loan funds tend to be trading at slight discounts to par, where high yield corporate bonds are currently trading at modest premiums. We also find that high yield municipal bonds remain somewhat attractive as there's continued ongoing talks from Washington, D.C. about raising income tax rates, and so there's continuing to be robust demand for those bonds, and that backdrop continues to push more and more funds into that particular area. In summary, with COVID cases remaining low and vaccination levels in the U.S. and other parts of the world starting to get into the levels where there is herd immunity, we're seeing things reopen, and it feels like we're getting back to a much more normal environment. There's a lot of pent-up demand out there, which is causing some inflation that the Federal Reserve considers to be temporary, and it'll be important to watch that because equity market valuations are once again back at historically high levels. And so for those to be maintained, you tend to need to have everything going well with very few, if any, unexpected surprises. And, in trying to take a longer look at that, we've seen a period where the market declines that we've experienced over the past 3, 4, 5 years have tended to be pretty short and sharp and been able to rebound from those quite quickly. However, when we look back over the extended history of the stock market, getting longer term declines does happen. And if you have a time frame of, say, 20 plus years, you should expect that you're going to run into both types of cycles. And so if you happen to be in one where you've started out and it's down, those don't last forever. Neither do the ones that are going up. So looking at how you'll navigate through those and the types of strategies to address those can be an important piece in making sure that your long-term investment plan is successful. With that, we hope you have a good summer, and we look forward to following up with you in the coming quarter. Thank you.